Howdy, folks. This is episode 4 of this series on planning for high earning individuals and families. Thanks for watching and listening. Today, we're going to talk about investment strategy and implementation. And I will tell you that there's really only one thing that matters on this particular topic, and that's consistency. There's two pieces of consistency that I think matter. One is consistency in saving, and the second is consistency in strategy. And I want to emphasize that we're talking about investing. We're not talking about trading. That's a whole nother conversation. So let's talk about saving. First and foremost, automate it. Chances are very good that in your realm of investment accounts, however many you have, the one that probably performs the best over the long term is your 401k or retirement savings plan. It might be a 403b or something like that. And the reason why is you systematically put money in it every couple of weeks. And the other reason why is you probably pick an investment strategy, be it a target date fund or something else, and never change it. So let's delve into strategy a little bit. Recognizing that the most important thing is that you save consistently and you save enough. You need to match your strategy to your time horizon. That means you might have short-term strategy, a mid-term strategy, and a long-term strategy. And by that, I mean you need to match the volatility of that strategy with the time horizon. Lower volatility, shorter time horizon, higher volatility, longer time horizon. And the relationship there is, it's very, very hard to get return without volatility. Now, in the short term, I'm not worried about return on investment. I'm worried about return on principal. In the longer term, I'm definitely concerned about return on investment. And the point is, we in the investment community like to talk about risk. What we're really talking about is volatility, because the risk in any decent investment strategy that is matched to your time horizon, the risk of likelihood of losing your deposit, that is your principal, is next to zero. It's never zero, but we can make it pretty doggone close by matching your volatility with your time horizon. Now let's talk about diversification. More diversified tends to mean less volatile because you have money spread across different investments. It also means that you're never going to perform to like the S&P 500 index, because you don't own the S&P 500 index, you own a bunch of different things. Now, can you be more concentrated? Sure you can. It just means you have more risk, you have more volatility. And if you invest in a single stock, you might have real risk, because sometimes those companies go out of business. Just look at the composition of the S&P 500 over the last 50 years. Companies definitely come and go. So if you're going to concentrate, I want you to have a larger cash reserve. And the first thing you need to establish when you're investing is a no-purpose cash reserve. So let's summarize. Systematically saving is the key. Having a no-purpose cash reserve allows you to stay in the market for a long period. Choose a strategy that's matched to your time horizon. And that way you might have multiple strategies as a result. And then last, when your gut is telling you to get out is probably the time you need to stay in more than anything. The highest consumer sentiment measures were just before recessions. February 2000, January 2007, February 2020. The lowest, March 1982, October 1990, October 2001, February 2009, February 2020, and the all-time low, June 2022. You probably know what happened to the S&P 500 since June 2022. It's up 15.4%. Thanks for listening and watching. Let me know your feedback. I'll see you again next week.